You hear it all the time, right? The green revolution is here. Electric cars are everywhere. But then you see headlines about global oil demand hitting all-time highs. So, what's the real story? In this explainer, we're going to cut through all that noise and get to the heart of oil's very complex and, yeah, pretty contradictory future.
So is oil some kind of dinosaur on its way out, or is it just changing its role in our world? Honestly, the signals are pointing in completely opposite directions. It's confusing, and that's the paradox we are going to unpack today. Okay, let's start with a big number, $236 billion. That's the staggering amount airlines are projected to spend on jet fuel in 2025 alone. It's a massive reminder that huge parts of our global economy literally cannot function without oil. But that is only half the picture.
Now look at this, 17 million. That's how many electric vehicles are expected to be sold this year. We're not talking about a slow drip here. This is a full-on disruption of one of oil's biggest and most important markets. So what gives? How can both of these things be true at the exact same time?
Here's how we're going to break it down. We'll start with the oil paradox. Then we'll get into why it's so hard to quit, in the persistence problem. After that, we'll flip it and look at the slowdown story. Then we'll tackle the absolutely critical investment dilemma, and finally, we'll map out the path forward.
All right, first up, the oil paradox. The future of oil isn't some story of endless growth, but it's not about to fall off a cliff tomorrow either. The reality is way more complicated. Think of it more like a long, bumpy plateau.
Just look at this chart. Yeah, demand is technically still growing, but look at the pace. It's slowing way down. You can see how the growth for 2024 and 2025 is just a fraction of the historical average. And here's the real kicker. For the first time in decades, oil's share of the total energy mix has actually dropped below 30%. So even as we use a little bit more, it's becoming a less important piece of the overall pie.
So that leads us right to section 2, the persistence problem. If the growth is slowing down so much, why isn't demand just cratering? Well, because in certain parts of our economy, oil is incredibly sticky. It's really hard to replace. This chart tells the story perfectly. That green slice, road transport, yeah, that's where EVs are making a huge dent. But look at the other major pieces of the pie. Aviation, shipping, and especially petrochemicals. There just aren't cheap, scalable alternatives ready to go. These are the sectors that are keeping demand locked in. Let's just zoom in on aviation for a second. The sheer energy you can pack into jet fuel is just unbelievably hard to replace. And while there's this promising alternative called sustainable aviation fuel, or SAF, it makes up less than 1% of all jet fuel being used today. It is nowhere near scaling fast enough to make a real difference, yet. And here is the real anchor of oil demand, the part that almost nobody talks about. The International Energy Agency expects that petrochemicals, the basic building blocks for plastics, solvents, synthetic fibers, you name it, they're going to become the main driver of demand growth. Our modern world is literally built out of this stuff.
And we also have to ground this conversation in a global reality. As of 2023, there were over 666 million people who still didn't have access to electricity. For a lot of developing economies that are building out their infrastructure, oil is still the cheapest and fastest way to power their growth. That's going to drive demand for many years to come.
But that persistence is being met by an equally powerful force pulling in the other direction. That brings us to section 3, the slowdown story. Because for all the reasons oil is sticky, there are some undeniable trends that are putting a ceiling on its growth for good.
And the biggest character in this story is, of course, the electric vehicle. By 2030, EVs are expected to wipe about 5.4 million barrels of oil demand off the market every single day. That's a massive bite. And it's exactly why pretty much every analyst out there sees demand for gasoline and diesel peaking before this decade is even over.
All this uncertainty leads to this huge split in what the future looks like. On one side, you've got the IEA, basically the energy watchdog for developed countries. They see demand hitting that plateau around 2030, maybe even leading to an oversupply. But on the other side, you have OPEC. They don't see a peak happening until after 2045. I mean, that gap between them isn't just a small disagreement. It represents two fundamentally different bets on how fast this green transition is actually going to happen.
Okay, this brings us to a part of the story that is so important but almost always gets missed. Section 4,
the investment dilemma. Because this isn't just about how much oil we want to use, it's about how much we can even get out of the ground. And it all comes down to a hidden force called the decline rate.
So what the heck is a field decline rate? It's actually a really simple idea. Once you drill an oil well, it doesn't just pump out the same amount of oil forever. Its output naturally goes down every single year. You can think of it like a tire with a slow, constant leak.
And that leak can be incredibly fast. A modern tight oil well, like the ones you see all over the US, can see its production just plummet by more than 35% in its first year alone. So, just to keep your total production flat, you have to constantly be drilling brand new wells just to replace what you're losing from the old ones.
This creates what's basically a massive investment treadmill. The industry has to spend around $500 billion a year, every year, just to keep production exactly where it is today. That's not to grow, that's just to stand still and fight against those natural declines.
And here is the razor's edge, the big dilemma. If investment in new wells dries up too fast, maybe because of new policies or investor pressure, we won't be able to replace that declining production. That could lead to supply shortages and crazy price spikes. But if we invest too much, right as demand is about to peak, we risk a massive market crash and literally trillions of dollars in wasted projects. Getting this timing right is the single biggest challenge.
So when you put all these pieces together, the paradox, the stickiness, the slowdown, the investment dilemma, it brings us to our final section, the path forward. How do you navigate this? It's not about flipping a switch off. It's about managing a very long, very complicated goodbye.
So what should you be watching to see how this plays out? On the demand side, keep an eye on how fast EV adoption is really moving, and whether alternatives like SAF can actually scale up. On the supply side, it's all about the chess moves from OPEC Plus and the US shale producers. And running underneath it all is that decline rate math that's going to tell us just how much pressure is building in the system.
At the end of the day, here's the real takeaway. A smart energy transition isn't just about shouting "end oil now." It's about a careful, precise, and data-driven management of its decline. One that pushes hard to switch away from it where we can, like in cars, while making sure we don't create chaos in those sectors where it's still absolutely vital. Ultimately, the real question we need to be asking isn't how do we shut oil down tomorrow. The real, much harder question is how do we skillfully navigate this long goodbye to avoid both a climate disaster and economic turmoil. That is the tightrope we all have to walk. Thanks for watching.